Hello and welcome to Cheppy Today. My name is Will, and today I'm going to be going through something a little bit different. A trading strategy for those who don't have the time to try and time the market. If you want to be kept up to date with the discussions, remember to give us a like and to subscribe. So we've all been there. You want to invest in Bitcoin, but you're not sure if it's the right time. The classic model of buy high, sell low hasn't really been working out for you. And whenever you buy, the market subsequently crashes, as if literally in spite of you. That's always the way. But what if there was another way to invest? One that didn't involve poring hours over various charts and indicators in order to work out the best time to enter? Well, there is, and for the most part, it seems to work out pretty well. That method is called dollar cost averaging. Instead of placing a lump sum on Bitcoin at a certain price, dollar cost averaging spreads out the investment over days, weeks, and months. To explain, let's try some roleplay quickly. No, not that kind. Dirty-minded. So, it's Christmas 2017. You're sitting around the dinner table feeling pretty full after gorging an entire bird. You check your Blockfolio. Bitcoin is around $15,000 after dipping from 20k just over a week ago. Not a bad time to buy, or so you think. What's that they say? Buy the dip. Yeah, what could go wrong? Screw it, you say. I'm all in. A modest investment of, say, 10k would have netted you a loss of around 40% from that point until now, leaving you with little more than $6,000 from your original 10k investment. Sure, in the long term, it could still turn around, but what's the lesson here? It's probably not best to try and time the market. That's the point of dollar cost averaging. So let's try a different scenario. It's coming up to Christmas 2017, Bitcoin just hit a high at 20k. You don't want to miss out, but you don't want to time the market, because as we know, that can be messy. So you make a plan. $100 investment each week, every week from the weekly close following Bitcoin's all-time high, until, let's say for argument's sake, the last weekly close this Monday. So let's work it out. The initial $100 investment would have occurred on the 18th of December 2017, with Bitcoin at a price of $19,550, netting you a cool 0.005 BTC. Congrats, you managed to purchase 1/200th of an entire Bitcoin. Fast forward 2 months to the 12th of February 2018, and Bitcoin is at a price of $8,178. Ouch. Your $100 investment gathers you 0.012 BTC today, and you picked up a total of 0.74 BTC, amounting to a USD equivalent of $605. So far, you've invested $900. Okay, so not great. We've incurred a loss of around 32%. But this is a bear market, what do you expect? Still better than buying at the top. 6 months on, and Bitcoin is at a price of $8,200. Again, $100 today gets you 0.021 BTC, and your total Bitcoin accumulated stands at 0.37, with a USD equivalency at $3,091. You've invested $3,300 so far. We're getting a little bit closer to evening out. Finally, skipping ahead a little, let's say 19 months, Bitcoin is citing a price of $9,051, and you managed to scalp 0.011 BTC with your $100 today, bringing your grand total to 1.29 BTC, with an end-of-study USD equivalency of $11,693. In total, you invested $7,900, which brings your total profit to $3,793, marking a 48% return on investment. Not too shabby. So it seems the dollar cost averaging strategy appears to have paid off. Not to mention that a fair amount was invested near Bitcoin's all-time high, and within a bear market full of uncertainty. Moreover, if the study was undertaken during the latter half of 2018, the results would have been even more impressive. For example, if we started the study near Bitcoin's bottom, which was around the 17th of December 2018, when Bitcoin was at a price of $3,252, investing up until this Monday, you would have gained 0.59 BTC from an investment of $2,700, a return on investment of approximately 60%. Now, obviously, this is no substitute for buying the actual bottom. Investing that same $7,900 figure into BTC around the proposed bottom in December 2018 would have given returns of 151%, and an end total value of $19,800. But the chances of the average Joe calling that bottom are slim to none. Interestingly, if we average out Bitcoin's price throughout the course of the study, we get $7,161. We actually spent 32 weeks above this average buy-in price and 48 weeks below. Investing $7,900 into this average would have provided 1.1 BTC, an end-of-study USD equivalent of $10,266, a figure that still wouldn't have beaten the dollar cost averaging technique. The key takeaway about this strategy is that it negates FOMO, as well as the stress of timing the market and constantly checking price, all the while providing both gains in a bear market and at the very top of a bear cycle. It's not too bad. But as always, we'd love to hear your take. Would you prefer to dollar cost average your investments, or do you like the risk and potential reward of timing the market? So leave a comment, leave a like, subscribe, and we will see you next time.